On Friday, U.S. natural gas futures experienced a decline due to ample storage supplies and reduced heating demand. Nevertheless, they are poised for their most significant weekly increase in a month and a half due to voluntary production cutbacks taking effect. Despite Friday's downtrend, natural gas prices were on track for a weekly surge of over 14%, marking the most significant increase since January 12 and surpassing nearly four-year lows recorded earlier in the week. The price surge was attributed to Chesapeake Energy's decision to cut planned production for 2024 by roughly 30% due to the recent price plunge. This move comes as Chesapeake Energy is set to become the largest U.S. gas producer following its merger with Southwestern Energy. Finally, analysts observed a reduction in production, and it does appear that producers are indeed scaling back. Gas output in the U.S. dropped to approximately 99 billion cubic feet per day on Friday, from an average of 104 in February, though it remains below the record high of 106 billion cubic feet per day in December. The weather conditions are the primary influencing factor, leading to an oversupply in the market caused by diminished demand amid moderate temperatures nationwide. February marked the fourth consecutive month of decline in natural gas prices, attributed to a mild winter resulting in above-average stockpiles, despite record-level output sustained even during the Arctic freeze in January. Looking ahead, market analysts remain cautious, citing challenges in building a bullish case amidst historically low prices and a growing storage surplus. While demand is expected to ease with the approaching end of winter, colder than normal forecasts for March could potentially drive prices higher or, at the very least, prevent further declines. Additionally, market participants are monitoring the impact of a wildfire in the Texas Panhandle, known as the Smokehouse Creek Fire, which has doubled in size and poses risks to natural gas operations in the region. Analysts predict that low natural gas prices may hinder Tellurian Incorporated's ability to sell its Louisiana gas-producing properties, a move aimed at alleviating debt pressures to support its liquefied natural gas export project. On Friday, the gas rig count, an early indicator of future output, fell by 1 to 119. In 2023, the U.S. oil and gas rig count dropped about 20% after rising by 33% in 2022 and 67% in 2021 due to a decline in oil and gas prices, higher labor and equipment costs from soaring inflation, and as companies focused more on paying down debt and boosting shareholder returns instead of raising output. As a result, 28 independent exploration and production companies plan to cut spending by around 3% in 2024 compared to 2023. Given the current market conditions, the short-term outlook for U.S. nat gas prices leans toward a bearish trend. The presence of ample storage, consistent production, and moderate weather conditions all contribute to limiting the possibility of substantial price hikes. On the technical front, oversold conditions might prompt a brief short covering rally. However, any significant rally could face renewed selling pressure, as substantial price increases are unlikely until a significant reduction in supply occurs. Thank you for watching. Please don't forget to support the channel if you enjoyed the video. See you in the next one.